everybody. Welcome to your Wednesday edition. Just making sure it's Wednesday. You never know what's going on with regards to dates. Wednesday edition of the TraderMerlin show. Before we get started with our guest, I want to give a big shout out to Landis down in Singapore, Kevin Martinez, so I think he's on the East Coast, and Carrie Starr, who sent me wonderful bottles of whiskey for my birthday. Thank you guys so much. And those that send in happy birthdays, thank you so much. I appreciate it. I don't look a day over 28, do I? It's amazing. I'm only 28 years old. Just a little bit of gray hair, receding hairlines, and some wrinkles setting in. But anyway, let's get on with our discussion for today. Again, thank you guys so much for all the well wishes. Cheers to another year. And Margaret, I'll try to watch the language today. But unfortunately, when I look at the title for today's show, it is, Why Do Bonds Suck? Now, I don't think suck is necessarily a bad word, right? Our guest today to help me understand. And by the way, I did do Why Do Bonds Suck with an exclamation point and a question mark, because it's kind of inquisitive. Like, do they really suck or are they good? So let's bring our guest on the program today. We've got Mr. Bill Addiss joining us from the East Coast, I believe. How you doing, Bill?
I'm doing great, Merlin. How are you in the group?
Fantastic. I'm great. I think my group's pretty good, too. They've been pretty jovial lately.
By the way, I thank you for paving the way. I look forward to my 28th birthday coming up. So thank you for paving the way for us all.
Sadly, it's more of I'm celebrating the anniversary of my 25th birthday, but, you know... Thanks, Margaret. Margaret was thinking 30. Oh, you're a sweetheart. Let's dive right into it. And I like the topic because it kind of has this ominous note of, bonds suck and look so, evil and wrong, if you will. But it's not necessarily that this is a bad thing. I think as we go through markets, you understand that there's always periods where the stock market sucks, and there's times where the bond market sucks, and there's times other asset classes are not so good, so I can keep my mouth clean. Walk me through your perspective, because this is your world. You are the bonds guru, and I'd love to get your take on why you think bonds are not so good right now.
Thank you. And thank you, Merlin. Always good to talk with you and your group here, your audience. I have to agree. Bonds are not of value right now. And as you said, different products and different markets can come in and out based, valuation discussions. But, my fear is I've been doing a lot of educating to the OTA community on bonds with the Signature Series and XLTs. And I'm educating. I really have felt it more and more important that I have to clarify. Just because I'm educating doesn't mean I'm recommending. Mm-hmm. I mean, right now, I am hard-pressed to figure out why anybody would want to buy a bond in today's marketplace. And there's a couple of different reasons for that. But right now, looking at it as an asset category, the yields you're getting are so abysmally low that it just doesn't make sense from an investor point of view. And again, that can and will change. We know markets go through cycles. But I'm really hard-pressed to find why anybody would be investing in a bond, and my life is the bond market.
Yeah, I agree. And I think I wrote it in the description for the show today. I think that part of the reason that you're seeing a push for bonds is because it's been a historically normal, a rational place to go. For example, if you have a financial advisor, they're going to basically tell you something very simple like, okay, what's your age? And I would go to my advisor, hi, my name is Merlin Rothfeld. I'm 25 years old today. And he's saying, okay, you should put, 75% of your portfolio in equities, 25% in bonds, right? So whatever your age is, you put that in the bonds of your portfolio, and that should protect you. Well, if you're 70 years old, you in theory should be putting 70% of your money into bonds off these old historical models. And it's like, well, hold on a second. Even though that model over the course of history probably has fared rather well, there still are market timing principles where you go, you know what, right now is probably not the time to be putting money into bonds, right?
And let's lay out the reasons why, because we can throw through two or three. And in fact, the best support for what I'm first going to say is if you have the yield curve chart we were talking about.
Yeah, of course.
The yield curve. So if you look at that picture that we're showing now, that's a picture of the U.S. Treasury yield curve today, the dark blue line. And what you can see is we have a normal yield curve, short-term rates being lower than long-term rates. But if you look at the scale over on the right hand, look at the scale of this, the highest yield achievable in the Treasury market right now is if you lock up your money for 30 years. And at that, you'll get an interest rate slightly over 2%. And if you go 10 years, so you can see on the blue line, you're going to get a little over 1.5%, a 160 today. Well, that's fine. So you're locking in a 160 or a 2% rate by buying a Treasury. Here's the problem. Inflation has already started rearing its ugly head. And inflation, as we know, based on whatever metrics you're using, and we can use monthly or yearly, but bottom line, inflation is running by most metrics at least 5%.
Right. Yep. 5.4 is what I see.
Yeah, so you're earning either 1.5 or 2, depending how long you've tied up your money. And inflation is going to eat away. And think of inflation as a tax. That's what inflation is. So you're going to be taxed on that investment by the purchasing power. You're going to lose 2.5%. So your real rate of return on this is negative 1%.
Yeah.
What's the logic of that?
No, it doesn't. It doesn't make sense. It's not logical.
No. And the reason we're in this conundrum is because of quantitative easing. You know, as you can see by that chart, which is why I like this chart, the yield curve 2 years ago, the light gray line that you're looking at, was the yield curve 2 years ago. Mm-hmm. And what did the Fed do? Well, they dropped the short-term rates down to 0. So that end of the chart went from 2.5, or 1.5 rather, down to 0. But then, just as importantly, the Fed introduced quantitative easing. They started printing up all this money to buy all these treasuries to drive the prices up and the yields down. Well, congratulations, it worked. Yeah. Right? And we've manipulated the market. We've got yield curve manipulation going on. And right now, the rate of return investors are getting are not compensating them for what inflation is right now, let alone what I think you and I might agree to is the prospect of ever rising inflation pressures. Forget even the future. Just looking at it right now, you're not being compensated.
Right. So on this chart, you look back and you mentioned that light gray one, which is October 2019. That was a market getting back to normal, I would say. And now, October 2020 and current as of 2021, you can see that where I've drawn the little arrow there, horrible looking arrow, I must say, that's the Fed manipulating that short end of the yield curve. We've talked about that. And what about the long end, that 30-year side? You know, obviously the Fed is doing some little trickery there, but nowhere near the influence that it has on the short end of the yield curve. So what's allowing that long end, the 30-year, the 20, and the 10 that we see really start to rise like it has been?
Well, so you're right. So if we look from 2019 to 2020, rates came down, long end and short end.
Right.
Now, 2020 to 21, short end has stayed at 0, right? Fed hasn't touched the Fed funds rate at 0. But what you're noting is long-term rates have gone up. They've reversed direction from the year prior. And the reason for that really is twofold. Number one is that rising prospect of inflation. Mm-hmm. You know, if we start anticipating inflation, well, we want to be compensated for that, right? If you're going to tie up your money for a longer period of time in an expected inflationary environment, you want more return than if inflation is more abated. So we see that, and this is what we've talked about all the time. The yield curve is a forecasting tool.
Right.
So the yield curve gets steeper and steeper the more it predicts inflation. And that's been the growing threat this year. The other problem that we have is that the Fed is no longer engaged in quantitative easing. You know, during that period of 2019 to 20, the Fed was doing all that QE, buying all those treasuries. Well, for the last year, the Fed's rate of purchases has diminished greatly. So when your big buyer disappears, and the Fed was the biggest buyer during QE, mm-hmm. when the biggest buyer in anything disappears, what happens to prices? They go down and yields go higher.
Right.
So the Fed backing away, even before they do tapering, just not being the buyer they were, is also putting upward pressure to long-term rates. And by my estimation, neither of those factors are going to diminish.
Yeah.
Right? And that's what got us here. I don't see either of those diminishing. So I see those long-term rates continuing to go higher. The question is, and we'll get the answer to this next week, what is the Fed thinking about the short end?
I was just gonna. You stole it right from me. I was just gonna say, we've heard about the tapering process, and it's become much more of a talk track here over the past couple weeks. My assumption would be that starting next week, obviously the Fed meeting, guys, is Wednesday. You're gonna have it at 2:00 as the announcement, and then 2:30 will be the press conference. My guess is in the press conference you'll hear about what the Fed is going to do with regards to tapering. My forecast is they'll actually start cutting back a little bit on both the mortgage-backed securities and the treasuries, just because he has said we'll meet that in June or July of next year. We'll be done with our purchases, which would be a pretty significant decline in purchases. Right now they're doing $120 billion a month. What's your forecast for what they're going to be doing here with regards to tapering?
I think it's what I'm calling the faux tapering.
Oh, tapering.
Well, if you look, right, since the Fed stopped printing money last year, and you've seen that chart of, M1 and the Fed's the Fed's balance sheet. We do it all the time. Mm-hmm. But since the Fed stopped printing money, the Fed's balance sheet has continued to grow because of that 80 to $120 billion a month that's coming into that account that they keep reinvesting. So the Fed has been buying 80 to $120 billion a month without technically engaging in quantitative easing. They're not printing up any new money. They're just collecting the benefits of this huge portfolio that they own.
Right.
So that means if they don't, under their terminology, reduce those monthly payments to zero, they haven't even started to taper.
Right. And that's the thing.
They're not reinvesting as much.
Well, and if they haven't started yet, meeting that deadline to come middle of next year gets more challenging and more challenging as we go.
But even if they take that out, they're still not actually destroying new money.
Right.
They're just destroying the reinvestments. Unless they hit that $120 billion number, they're not actually going to be reducing their balance sheet.
The manipulation that goes on behind the scenes. I love it.
Oh, man, it is. And unfortunately, and I'm becoming more and more of a cynic, the press just seems to be an unwilling, complicit co-conspirator in this, just in terms of not really explaining things to the detail I would like to see.
Yeah. Christy asked a really good question here, and I think it ties directly into it. Chris says, why institutions would buy now 30-year bonds at close to zero when there is a chance for a rate hike? Are they stupid, or do they know something that we don't?
Well, again, I want to stress what the Fed does at the short end in terms of rate hikes. Don't necessarily assume that that's going to correlate to any specific change in long-term rates. As this picture you're showing shows just how dynamic the yield curve is. So if I'm an insurance company and I'm having to buy a certain amount of 30-year bonds because legally I have to, they're going to continue with that buying program irrespective of what interest rates are. They have to have government paper. But more importantly, I want you to see that when the Fed raises short-term rates, again, think of it like the physics. They're holding this end of the string. They're holding the one-day rate, the Fed funds rate. For them to raise that will most certainly impact short maturities. And the shorter the maturity, the more direct that correlation will be. But the further you go out of maturity, there's not necessarily any correlation. I mean, we've had situations where the Fed has raised the overnight Fed funds rate and long-term rates have gone down.
Yeah.
So we really have to stress this, short-term versus long-term. Interest rates are not all the same. They don't move linear.
Right. One of the things that we've talked about a lot in the program.
By the way, I'm sorry.
No, of course. One of the things we talked about a lot on this program has been, the different actions that one can do to control inflation. And obviously, Volcker's big thing, let's raise rates. Another one would be to reduce money supply. You have an interesting couple graphics. First, let's talk about money supply, and then let's focus on M1. If they start to rein in money supply at this moment, which to me, it seems very clear that they won't because they just want to keep the economy running and going. But if they do curtail and start to, return these bonds or pull money out of the economy, in my opinion, I think this could have a significant impact on the growth of the markets going forward if you take money supply out.
Absolutely. Absolutely. By many people's opinion, mine included, what the Fed has been doing since they turned on the printing presses 2 years ago is just creating asset bubbles fueled by the adrenaline of all this liquidity. I mean, we're going to show that M1 chart in a moment. The amount of cash in the U.S. economy is literally frightening, in my opinion. So what we've done is put all this liquidity out there in the market, and many people feel it is the adrenaline that's been driving a lot of this mispricing that we're getting, whether it's mispricing in real estate, mispricing in equity prices, mispricing in bonds. The adrenaline, by many people's estimates, is this Fed liquidity. So if they turn off that spigot, or more importantly, if they start sucking liquidity out, doesn't that not bode well for those assets that have done very well with all this Fed benefit?
I have that chart up here, the M1 money supply, and for those that don't know, I cite this one a lot where I just talk about how much it has increased. It's taken pretty much the entire history of tracking the Fed's money supply to get it up to $4 trillion all the way up to 2020, and then from 2020 on, we've gone up to about 18. So, you're talking about 14 or 15 trillion dollars worth of money supply, and then all of a sudden, conveniently, Bill, we stop M1 money. So we don't track M1 anymore by the Fed. Why would they do something like that?
This is reprehensible. This is absolutely reprehensible, and that's why I wanted to talk about it. Because just to reiterate those numbers, because if you think about it, and just to make sure everyone in the audience is on the same page, M1 literally measures all of the cash in the U.S. economy.
Right, cash deposits. Yep.
Cash and cash deposits. So money sitting in checking accounts, savings accounts, the physical currency that's in circulation, which is only about 4% of our money, money in short-term deposits. So it is literally the measurement of all of the cash in the U.S. economy. And as you can see, exactly as Merlin said, going all the way up to 2010, we never had more than $2 trillion worth of actual cash in the U.S. economy. And it grew at a steady, consistent, nice, manageable level, as you would like to see a growing economy do. And then starting in 2010, when the Fed turned on the printing presses and started creating more money, you can see that number went from 2 trillion up to 4 trillion. Right? And then the pandemic hit. Look at what has happened to the amount of cash in the U.S. economy. It has increased by 500%. I mean, there's now 20 trillion. We're swimming in cash. You know, we talked about this in another way, Merlin. You remember a couple months ago when we talked about the Fed is offering that overnight interest rate of 5% to try and suck cash out of the economy.
Right.
I mean, the Fed is worried because too much money does cause inflation. That's kind of economics 101. Well, here's your picture of too much money at an unprecedented level. I mean, this should scare economists, and it does scare economists. So what was the Fed's answer? And I find this reprehensible. They announced in June of this year they're no longer going to be reporting M1.
Yeah.
They just stopped.
It's like, oh, we don't want to look at it anymore. We don't want to look at that anymore, right? It's like,
we don't like what it says, so we're not going to show it to you. I can't wait for the Commerce Department to announce, we're not liking these inflation numbers, so we're not going to show them to you.
Yeah, these gas prices in California. These gas prices in California are so bad. We're just not going to put the price on the pumps anymore. Just.
I find this reprehensible, and I have to hold the press personally somewhat accountable. Why aren't they holding them to task for this? Why isn't Chairman Powell getting a question at the last Fed meeting? Hey, nobody likes what M1 says, but why did you stop reporting it?
You know why? Because, look, if I'm one of the reporters and I ask that question, Powell's going to go to the person and go, don't ever answer a question from them again. Don't even let them in here.
That's the last meeting you'll ever go to. That's exactly right. Yeah. But I think it's a fair question to ask. Just because you don't like what a number says, what's the precedent you just stop reporting it? I mean, I go back to the old Paul Volcker days of stagflation.
Yeah.
The name hasn't come up yet, but I personally am very worried about stagflation. I think that's where we're going. And from a central bank's point of view, this is the worst possible scenario. But back in 1979, when M1 was exploding, M1 is actually released. How about the fact that I know this? Every Thursday afternoon at 4:10 New York time. That's when they release M1. And literally Thursday, there wouldn't be a lot of bond trading going on. At 4 o'clock, at 4:10, the Fed would release the M1 number. We'd see how much cash there was, and the market would trade from 4 o'clock until about 6 o'clock because the bond market's over the counter. And we literally just traded M1. It was the most important statistic when you're in an inflationary environment. Mm-hmm. Now the Fed has said, we don't like the data, so we're not going to give it to you.
Yeah.
I think that's reprehensible.
It's crazy. It's funny. Margaret has a good comment by Margaret. She says, they will be too busy watching for $600 transactions done by hardworking Americans. Yeah.
Right.
I mean, it is funny that, just the numbers have gotten so bad. And I think part of it is, if you look in any economics textbook, they'll tell you one of the main causes of inflation is increasing the money supply. And you look at that chart and it's like, someone's screwing up over here because the money supply is 5x plus in less than 2 years. It's unbelievable.
I feel like I'm living in a Wizard of Oz movie. Pay no attention to that man of inflation behind the curtain. Pay no attention.
Well, hopefully we won't go back into black and white video. Let's see. Let's ask this question. It's a really good one. He says, obviously we're painting this picture, and again, this is your opinion, and I echo this opinion, that bonds right now, they're trash. Bonds are not the place to be parking capital because there's just no return. You're not going to beat inflation. Now, if you look at other areas of the market, there might be some areas of interest. So Les says, if not bonds, where should an investor put his or her money?
Well, again, the question is, what's your goal? So if we're assuming you're a traditional bond buyer, you're looking for income. That's, just traditional 101.
Right.
And quite frankly, right now, there's a lot to be said for preferred stocks or high dividend paying stocks. where you don't have the benefit of the defined maturity. Obviously, one of the key benefits I like about bonds is when you're going to get your money back and when. You don't have that. But the preferred market has some very interesting yields just looking at it from a pure income point of view. I like the preferred market or high dividend paying commons even for income generating purposes.
Yeah.
The other reality is, and I'll admit I'm wrong, I think the stock market is way overvalued. But here's the stock market hitting its 65th record high this year. It doesn't seem to be paying attention to me.
No.
So,
it doesn't care.
Market, it doesn't care that I think it's overvalued. So maybe participating in some equity upside that I'm surprised by, but more importantly, getting a dividend yield of 3% is easily achievable in that market. Mm-hmm. I think there's something to be said there. I don't like them for liquidity purposes, but when you're buying them as a new issue, I do like tips. Now, they are more complicated and they require some education. You don't enter into that market. But TIPS, as we know, is a bond that if inflation does continue to rear its head, it will turn that negative into a positive. You need that volatility, though, of inflation to go higher.
But I mean,
I think it is. So for that reason, I like TIPS.
Yeah, and I've got the TIPS up here right now, and it's kind of off screen a little bit, guys, but it's actually negative 1.028% right now. So, this is kind of a problem because if you buy it, you're literally losing 1%. So if you do foresee in the next year or two or maybe longer that rates will jump up and get to like 4 or 5%, then TIPS are a good option. But if you think it's going to just go up like 0.25% from here, TIPS are probably not the way. You need a significant move up in interest rates to make these TIPS worthwhile, right?
And specifically, you need a big increase in the CPI rate, not just interest rates, because you're pegged specifically to the CPI. So if you're like me and you're really worried that inflation could really skyrocket, you might think of TIPS as kind of portfolio insurance. Mm-hmm. Here's a product that if that happens will actually benefit from that. But you need that volatility. To stay at a high interest rate of 5% like it is now isn't going to help you. You're speculating that rates will go higher from the present level.
I'm going to throw my 2 cents into the question from Les, and this is one that is highly speculative. If you're just looking for a safe haven for your money, see, if you buy, this has been my argument against buying stocks that have big dividend yields, because if you buy a stock that has, let's say, a 5% dividend yield, you're like, great, I'm getting 5%. But if that security is like the market and overvalued right now, and it drops 50%, you're down 50% in your principal, but you're making a 5% yield. It doesn't really make much sense. I mean, to me, it's too risky, knowing if you believe the market's at all-time high. This one might even be riskier, but this is where I'm kind of leaning to right now is I could go buy stable coins of USDC, of Tether, of Paxos, and I could put those on an exchange and be getting 8% per year on a stable coin, so I'm not subject to the market volatility of the currency, and I could do euro, dollar, yen, I could do all of them. Only risk there I have is that exchange risk. Do I get hacked there? Is there regulatory issues? But I tell you what, why would I ever want to hold a bond making 1% when I can hold a stable coin, which is basically backed by US dollars or fiat currency, and make 8 to 10%? To me, that makes much more sense. But there is certainly some inherent risks there as well.
Now, forgive me, and the stable coin, honestly, is not something I've spent a lot of time on, and maybe others have the same question. Where are you getting that 8 to 10% from?
So, for example, we'll use one, let's say Crypto.com is one. So Crypto.com is a lender. So you're depositing assets there, and they're lending those assets out and generating greater than what they're paying me. So if they're paying me 8%.
Is that 8% guaranteed in any way, or they're paying it now? Is that a commitment they'll continue to pay it next month?
Good point. I have seen them adjust the rates, but the rates usually go from actually right now, BlockFi just increased theirs from, I believe it was 8.25 to 9. So they jumped 0.75 of a percentage point extra on top. But I have seen them drop. But it's not like they go from 8% to 1%. You know what I mean? It's
again, I'm going to be cynical, and I don't mean to be on you. But
Do it.
You say you haven't seen them drop yet. We're talking about a very new market here.
Absolutely.
We haven't seen much of anything.
True, but also, I'm not going to be...
So could it drop, I guess, is my question.
Absolutely. Well, here's what's interesting about that, Bill. When you look at the market, there's dozens of people who do the same thing, right? So if all of a sudden Crypto.com drops me from 10% down to 5%, I'll pull it out and go to the other one that's going to give me 9%. So I shuffle mine around for that.
Gotcha.
Yeah.
Cool. As the markets mature, I hope that type of interest remains viable. That would be really cool.
It's obviously risky, but I think what it does is it speaks volumes to this kind of paradigm shift we're seeing. And that paradigm shift is we have to historically go to the equity markets, the bond markets, which have been controlled by financial institutions, right? They've told us to do these things. And then here we have a new marketplace where it's saying, you know what, it's your money. If you want to lend it out, and you get the interest instead of your bank.
Right.
That, to me, makes sense. But who knows? That's one of the areas.
Conceptually, I'm with you 100%. I just didn't know the nuances of that market, so thank you.
And there are risks. I mean, come on. There's no way you're going to get 8% risk-free.
Well, that's where I was going.
Absolutely. I have no, and I can't argue that at all. I mean, there's certainly, like, I have mine spread out at like 20 different accounts right now because I'm worried that any one of those could fail, so I don't want to keep all my assets in one.
Right. Good.
Let's see. Medic says, so if we go into stagflation, does that basically mean doing iron condors all day? Well, I mean, I guess, yeah, because things would basically traverse sideways and just be stuck sideways for a while. So, yeah, that would probably be an option. Naum says...
Can I expand on that a little bit?
Yeah, absolutely.
Because I just want to point out from the Fed's point of view, I said that stagflation is the Fed's worst problem. And maybe if I could just highlight that real quick.
Yeah.
So let's say the Fed, like the Bank of England, has been very adamant in the last couple of months saying we're really worried about inflation. Inflation is our number one issue. So we would perceive what they're really trying to tell us is they're going to start getting hawkish about inflation. Now, the way a central bank would respond if they're worried about inflation is the first thing they're going to do is they're going to start raising that short-term interest rate, right? The one that's been at zero, the Fed funds rate. So if they view inflation as the primary problem, their instinct tool is to start raising short-term interest rates. But if we're in a stagflationary environment, we're already saying that the economy is weak. So by your addressing the inflation component, you're actually now raising interest rates, which means the economy is going to get even weaker.
Yep.
Right? What helps one hurts the other. Or if the Fed says, and I'm not, again, in any way foreseeing this, but let's say the Fed says, we're really worried about the economy. We're not bouncing back as well as we should. The stagnant economy part has now become the most important consideration. So what are we going to do? We're going to turn on the printing presses again. We're going to do quantitative easing. Yeah. Right? We've already got the Fed funds rate at zero. We're not going any lower with that. So the Fed then says, okay, the stagnant part is the problem. They're going to do more quantitative easing, which is just going to exacerbate the inflation problem.
Right. Yep.
Right? What helps one hurts the other. The Fed's in a no-win situation.
So how does one get...
The Fed put themselves in a no-win situation.
Exactly. Yes. Let's make it sure the Fed put themselves in a no-win situation. But, in that type of worst-case scenario, how do you get out of it? I mean, I've asked you this one before, and you've answered it, but I think it might be worth repeating. It's like, how do you get out of that type of environment? Like, fixing an inflationary market, easy. Fixing a deflationary market, okay, we can do that as well. But when you have this perfect storm of slowing growth, increased inflation, higher unemployment, and lower earnings, it's like, well, shoot, how the heck do you get out of that?
Right. And the only answer I can give you is history. When, we go back to Paul Volcker, when he was the head of the Fed, when inflation started rearing its ugly head, the Fed decided this is the most important consideration. And Volcker even said, the U.S. economy is worthless if we don't deal with inflation. Because inflation was running at 21% a year at that time.
Yeah.
So Volcker's answer was, and you can go back in history, they raised the Fed funds rate by 700 basis points at one meeting. Woo-wee. 7%. Right? You and I are used to a quarter point. Yeah. I mean, maybe we've seen a half point once in a
50.
while.
I think 75 is the most I've ever seen.
Yep. In October of 1979, go back and check, the Fed had an FOMC meeting. They raised the Fed funds rate, we now know, in hindsight, by 700 basis points.
Wow.
They literally raised interest rates so high as to collapse the U.S. economy. That's what it took to bring inflation out of the market. Because in 1979, you were too young, you 25-year-old. But in 1979, for those of you who might remember, we were in a consumption frenzy. Right? If inflation's running at 21%, the attitude was go out and buy it now. Mm-hmm. Because if you wait until next week, it's just going to be more expensive. It causes this consumption frenzy. Mm-hmm. So Volcker literally raised interest rates so high as to literally strangle the economy and forced it into a recession and saved the U.S. economy. As you can see, I do have great respect for the guy. I'm biased.
Yeah, absolutely. No, hey, I mean, he fixed things. But
he had the courage. But if you imagine the Fed chairman now doing that, 700 basis points?
Maybe they'd be strung up.
Absolutely. They'd lose their, it's a political appointment, as we know.
So when was that? Well, because I'm looking at the S&P 500 right now, and you only have like 1 month of just monster down. That was the Black Friday.
I want to say it was the FOMC meeting the second week in October, 1979.
Because the market it continued to soar. I mean,
Well, this is the beauty of the Fed. I'm sorry, I have to get a life. This is the benefit of what was going on at the time. Because the way the Fed operated back then, they had no transparency whatsoever. Mm-hmm. We didn't know what the Fed was doing. The idea that we get a press conference now and we get an actual statement, Volcker didn't believe in any of that. That all came in with Greenspan and subsequents. Under the old days of Volcker, the Fed would meet, the FOMC committee would meet, like they do now every 8 weeks, and then they would disband. They literally wouldn't tell us what they had decided to do. And they did that intentionally because they knew they were taking such draconian actions that if they actually telegraphed to the market what they were doing, there would have been such a crisis of confidence to the US dollar. Yeah. So Volcker was a man of his time. He didn't believe in telling the market literally anything. So what would happen is it would sometimes, like in this case, it took us months to realize what the Fed's target was. In other words, we could see the Fed funds rate going up. We knew the Fed was letting it go up. But as it kept going up and the Fed wasn't interceding, the question that took months to answer is how high are they going to let it go? Mm-hmm. And the ultimate answer was 7% higher by the time this whole thing. But it took months for that to actually occur over time.
To paint that picture, I know we've looked at this one. The Fed funds rate historically, this is just pulled up. This is Federal Reserve data. You guys can see it. Back in 1980, you're up at almost 20% on the Fed funds rate.
Right.
Like most of us can't even remember a period of time when it wasn't locked at zero.
Right. Banks have free money now. Back in October 79 into 1980, the period we're talking about, 20% was the rate that banks had to pay to borrow money.
Nuts.
Mortgages were 16%. We've had this discussion.
Yeah.
30 treasuries were at 14%.
It just marvels my brain. It's just like I'm sitting here going, man, I locked in a 15-year at sub 3%, almost sub 2%. I couldn't imagine trying to make it ends meet on a 16% mortgage.
Exactly. Welcome to stagflation.
Right.
That's why those of us with white hair are afraid of stagflation.
Oh, wait a minute. Does that mean I'm afraid of stagflation too? Because I got a lot of white hair.
You've got a ways to go yet. You're only 25. You're a young whippersnapper.
So was Volcker your favorite Fed guy?
Yeah.
Yeah?
Yeah. He had the courage of his convictions.
Yeah.
He was not a political animal. He had the courage of his convictions. I also believe, when the financial crisis hit, President Obama used Paul Volcker as his economic advisor, and Volcker wanted to put back in the Glass-Steagall Act, where we separated banks and brokerage firms.
Yep.
And I think we needed to do that. I think we have too much risk by having banks and brokerage firms and what we have today.
I agree.
The segregation of industries was something Paul Volcker fought very hard for on behalf of President Obama. And they got the Volcker rule, but that was just a pacifier.
Right.
They really wanted the Glass-Steagall Act put back into place. And the fact that he, as the former Fed chairman, was willing to fight that fight with Congress, I was impressed. Mm-hmm. Yeah, he had the courage of his convictions.
Margaret asked a couple good questions here, as usual. She wants to know, do you have faith in bond ratings?
No.
Didn't take much time for him to think about that one. I don't either.
And nor should you.
Yeah.
Because the same problems that got us into trouble back in 2008 are still systemic problems as we sit here today. From a structural point of view, there's nothing different in the world of ratings. It's the same 8 companies that are providing the ratings. They still do their own modeling. The business model where the issuer pays for the rating is somewhat problematic. I mean, literally, the systemic issues that created the mortgage crisis and the bad ratings is still exactly the same business model. Nothing has changed. The only thing that is hopefully better, is that the buyers of bonds have become smarter. Because as an industry, we got lazy. Mm-hmm. We deferred all credit analysis to the rating agencies. If Moody's said it was AA, that was good enough for us. We learned our lesson the hard way.
Yeah.
So your large institutional investors, like your BlackRocks and your Fidelities, they've really beefed up their own research because we've realized we can't defer to just the rating agencies. Although, for legal purposes, we have to defer to the rating agencies, right? That whole definition of fiduciary responsibility.
Right.
But no, I'm greatly distressed that nothing is different, and I blame Congress for that. Because these companies are called rating agencies because they get certified by Congress to provide these ratings.
Yeah.
And Congress has opted to do absolutely nothing about the fiasco we had back in 2008. So it's still there today.
Yeah, I think that brought to light for many Americans and just people around the world that, do you really trust these rating agencies? If there's somebody behind the scenes paying for a rating, I mean, come on. It's be like the restaurants are paying Yelp to give them higher stars, and that's pretty much what was happening.
Right. Yeah. And if you're a company like GE, and you're issuing boatloads of bonds and you're paying the rating agencies a boatload of fees, I mean, realistically, you expect better treatment than somebody that maybe issues a bond once every 10 years. Mm-hmm. I mean, that's just an unfortunate reality of the business model.
To parlay that. Yeah, absolutely. So
we're stuck with it, though.
And that's the parlaying into this next question from Margaret, which is right up the alley. I was thinking the same thing. It's like, we have these rating agencies to help us, I guess, have guardrails on our investment decisions. And obviously you hear about the SEC making sure it's safe for investors, yada, yada, yada. And if those guardrails, this is AAA, this is AA, this is AA plus, whatever, are there to give us an idea of how risky that investment is, yet that investment is maybe being manipulated by the issuer or whoever's issuing these bonds, what should we do if we can't trust those agencies? We have to go out there and do your own legwork now?
Really? Well, in the institutional world, that is the answer. They have beefed up over the last decade substantially to their credit research department. You and I, as a rule, don't really have those resources.
Yeah.
So again, that becomes problematic. That is also, maybe a reason for more diversification, like a bond ETF, but that's kind of a separate discussion. Mm-hmm. But the credibility of the ratings should be suspect. The problem is, though, our laws are based around these ratings. I'll give you a perfect example. Ford right now is a junk bond, which means that any portfolio that has to invest in a high quality can't own a Ford bond. Now, BlackRock might have a great opinion about Ford. The fact that that's a junk bond means they legally can't put it into their portfolio. And again, the rule is designed to protect the investor.
Sure.
But if we don't trust the ratings and then we turn around and base our laws on this, we've got a screwed up system here.
No, say it ain't so, Bill. The system's screwed up? I find this hard to believe.
Well, it even went as far as our Supreme Court. Because when all of those investors lost all the money they did in the mortgage market years ago based on mortgage ratings, we had a huge amount of lawsuits against the rating agencies. And all of those lawsuits were brought up to a class action lawsuit that went to our Supreme Court. And not less past November, but 2 Novembers ago, our Supreme Court ruled that rating agencies cannot be held fiduciarily liable for their ratings.
Wow.
See, I was hoping if Congress wasn't going to do something, maybe litigations would force some changes if they were getting sued and had to make payouts. But the Supreme Court immunized the rating agencies against any litigation.
So now
they can't be held responsible.
Yeah, they're untouchable now.
Yeah.
So now they really don't care. It's like, we'll put what do you guys want? Just tell us what you want and we'll give you a rating. All right, last one, and then we'll wrap up here. Adam's been asking me this a few times. He says, does Bill see any correlation between crypto markets and bonds? I know that you're kind of newer to the crypto space, but do you track that for any correlations?
Where I'm looking for the correlations to exhibit itself better, and I'm looking at this, is looking at the aspect of crypto as the haven of safety that bonds provide. Bonds have historically been a haven of safety. And the question is crypto going to do that? And, some people obviously do the same analogy to gold, and compare crypto to gold as a haven of safety. So I think there's an interesting discussion there. I do think, though, crypto, looking at it as an asset, which I do believe it is, will be susceptible to changes in interest rates. Just for nothing else like carrying charges, right? If you're buying a boatload of crypto or crypto futures, which you can now do, we have to build in pricing models for those crypto futures that embed in the cost of borrowing money.
Right.
So that portends that they're going to act just like any other commodity. In a rising interest rate environment, there's upward pressure to prices because the carrying charges are increasing.
Well, I keep looking at it as well from that safe haven perspective. I personally think that some of the flight to gold has moved into, some of that money is going into cryptocurrencies, particularly Bitcoin. I think is still the lead with regards to that, the digital gold. But I don't see really tight correlations yet. I think once institutional involvement is fully in, we'll have much better.
I agree with you. Too early to tell yet, but those are interesting conversations to look at.
Absolutely. Tell me about your upcoming class. I know you've got a session called Bond Aid. I know you're doing some other stuff. What are your upcoming dates here that our students might be able to check out?
Hopefully, I should have been better prepared with the calendar.
That's all right.
Thanks to the pandemic, I've actually been getting more involved with the OTA community, and I've been enjoying it.
Good.
So we've got this 3-day series that talks about the interest rates, bonds, and the Fed. And the bias of that program is, I don't care if you never trade a bond. As we've been showing in this correlation, whether you're trading in other asset categories, equities, it's impacted by interest rates and the Fed and the bond market. So I would make you the argument, even if you never trade a bond, a class like this might be valuable. And the next class is the last week in November. So it's November 30th and then December 1st and 2nd. We'll be doing the 3-day Bond Aid class then. 3 days intensive on bonds. We get into the analysis. We talk about the Fed, the correlation with other asset categories. We started that program this year as part of the Bond Aid series. But in anticipation of that, as I'm sure your people know, we do the showcases.
Yep.
Where every week I take a little bit of the content and we expand on it, talking about what's going on today, kind of as a teaser. So between now and the end of November, you'll see me weekly on the calendar doing the signature series showcases. And that's a weekly situation. Awesome. And we also have an XLT on a monthly basis, but I can't find it on my calendar right now. I'm doing a bad job of marketing.
Well, if you guys
for the XLT, we just did one last week.
Nice. Well, I'm glad that you have more time to dedicate to the community, because I always love your participation and the things you bring to the table. I thought I had it where I could search for it, but I guess we'll have to forego that one. So I was bringing up the calendar here, thought maybe I could...
Thank you. I appreciate you trying.
We tried. No worries. Well, hey, man, Bill, thank you so much. I just wanted to bring you on because I know we had the conversation that bonds suck. And what we mean by that, guys, is right now, at this moment, they're not a great investment vehicle. Of course, history will change, time will change, and at some point, bonds will be great again and serve a port in your portfolio. But careful right now for those of you who are heavily loaded on bonds. You could theoretically be losing money due to inflation. So we want to look elsewhere for yield.
Perfect synopsis. Thank you.
No problem. All right, Bill, thank you so much.
You're a professional. I always love talking with you. Thank you.
You as well. And when you want to talk crypto, I'm ready. Bring it on.
All right. I got to learn more.
We'll share some knowledge.
Intelligent conversation.
Awesome. Thank you, Bill. Take care.
Be well, my friend. Be well. Thanks, all.
Guys, that was Bill Addiss. Just one of the sharpest minds I know with bonds. I love bringing him on. It's actually... I love bringing him on, but I also feel stupid sometimes when I bring him on because I'm like, man, sometimes I can't quite grasp some of those concepts. I know a lot of you learned a lot from Bill as well. So Bill is just awesome. Love having him on. Should be on every week. I'll try to bring him on more frequently. Once a month is where I'm going to try to get Bill on the program. But, what I really respect about what he was just talking about is throughout my career, I've met people who are always one side of the equation, meaning always this is the best asset class. And the first one I met that really changed my perspective on it was a guy who worked for Rare Coin Wholesalers down here in Southern California. We were at a trade show, I think in Las Vegas or Dallas or something. And it was all full of gold dealers. And gold dealers were all just going, buy gold, buy gold, buy gold, buy gold, buy gold. And I was like, okay, well, yeah, duh. You're a salesman. You're trying to get people to buy gold. I get it. I met this guy, Paul Busby. So Paul Busby, I walked by and started talking to him about it. And I go, what do you think about gold? And he goes, right now? I go, yeah. He goes, I'd be selling gold. I'm like, wait a minute. So wait, you're telling your clients to sell gold? He's like, yeah. And I go, well, you're a salesman. He goes, that's okay. People can sell their gold. It's just, we want to be on the right side and going with whatever trend is there. And gold, it's been trending down. I was like, I respect that because you would think that somebody who's in the gold business or the bond business will always be pumping their asset class and saying, that's the one. I love that Bill's like, bonds suck right now, man. Tips are kind of risky unless you think we're going to get a huge spike up in CPI or the long end of the yield curve. You're not going to get much on any treasuries out there and, not the best time. So I really love that he came on and talked about that. Again, if you want to know more, he's got a series called the Bond Aid. That's a signature series that he does, which is kind of all his content. That starts in November. He does a weekly showcase where he talks about his Bond Aid program. And he also mentioned that he's doing a signature series or an XLT session as well. So check your calendars for that one. All right, Adam says, Merlin, are you familiar with MetaMask? Do you think they're okay? Yes, I am familiar with MetaMask. I use MetaMask. They're okay. I'm sure there's some risks there, but right now, MetaMask seems to be doing fine. We actually, in the Crypto Investor Live program, we were showing MetaMask on last Thursday's session. I'll probably actually use it. I think I'll be using it again on our upcoming session, which is going to be tomorrow, as I modify something. Actually, it was Monday night session I was using MetaMask. So. All right, let's go and look at some economic calendar and earnings information stuff, and then real quickly maybe glance at some of these markets. Here is what we have for today. I just wanted to bring this one up because Boeing just got absolutely clobbered with regards to earnings. They were supposed to lose 17 cents. They lost 60 cents per share, yet they're only down 1.54%. You would think that there'd just be bloodletting over there if somebody missed earnings that bad. But no, it still looks great. Here is a chart of Boeing. I'll go to the more current data because I'm all the way back in, other than this giant sell-off that we had early in 2020, it's back on its feet. Here's your daily. Been drifting down, and of course, maybe that's reflected in the earnings. Right now, we're at a point where it looks really bad if it closes below this line at 206 that we see it's stuck at right now. Some of the other notable ones that reported earnings today, you guys can see you had Ford's. We talked about Ford a little bit earlier after market close. They reported earnings. They're up pretty big in the after-hours session. You had General Motors as well. So General Motors was beat earnings by 42%. They're down a little bit at 5.43% or 4.53%. Well, those numbers all mixed up. Anyway, big earnings numbers out there for pretty much everybody, and most of them were to the upside. We'll look at your economic calendar for today. This is what's happened. Right now, we have the rate announcement from Canada, which for those who are following the CAD USD, you did have some nice moves intraday. You saw a nice spike up, but really just came right back down as it hit that overhead supply. And to me, almost forming a bullish flag formation. We'll have to wait and see what happens over the next couple days on the CAD. But they reported overnight rate unchanged, which was to be expected. Now, we did have some issue with crude oil today. We were down about 3%. We did have crude oil inventory numbers much higher than expected. They had 4.3 million barrels of crude oil versus 2 million expectation, as you can see on this table here, and that really caused things to sell off a bit. Now, we have some still coming out tonight. If you're trading the Japanese yen, if you're trading, Japanese yen, you have a bunch of announcements, as you can see here. Now, how about this one? What about tomorrow? Tomorrow is the big day. After market close, I'm going to go ahead and throw this graphic up here because it is definitely going to be super popcorn trades of the day. The double popcorn trade of the day, that is definitely going to be Apple and Amazon reporting earnings after market close. That will be exciting. For those who might not be familiar, I coined this phrase years ago, which is the popcorn trade of the day. That is simply where you put your chart on a 1-minute time frame, you add on the after hours session so you can see the after hours trading, put on a 1-minute time frame, put your feet up on the desk with a bowl of Orville Redenbacher and just sit there and eat popcorn and watch it. Don't trade Apple, don't trade Amazon, because those things will move so much. I mean, you could easily see 10% swings in Apple or Amazon in a matter of seconds, the way that they report earnings in this after-hours session. So that's your exciting stuff for tomorrow. You also have MasterCard, Caterpillar, Altria, Gilead Sciences, Starbucks, Merck. I think you also have Shopify and a couple other big names there. And then from the economic perspective, there's one big announcement, and that's my line goes right through it because I can't draw with a mouse. G to the D to the P. Notice the big change here. Previous number was 6.7. They're expecting it to drop to 2.6. I'm guessing, my estimate is, that they have dropped this number so low that we'll come out of something like 2.8. And the market's going to go, woo, we're doing good, we're better than expected. No, we went from 6.7 to 2.8, people. We're getting beat up. Which, goes back to my topic from Monday's show, which is the potential for us to start to see growth slow down substantially, which starts to put that stagflation discussion more on center stage. And obviously that's something that'll take some more time to pan out with regards to overall stagflation being implemented, or not implemented, but reached. But that could be a start. So that's your major stuff for tomorrow. Other than that, I guess the sad news is someone said I look like Donald Trump right now. I hope I look much better than that. But yeah, I know my camera has been, when I restart this computer, it gives me new skin complexion. I'm colorblind, so I really couldn't tell. But I'll try to fix the orangeness out there. If you have comments, questions, feedback, send them in at TraderMerlin@gmail.com. I will be gone for the next few days. I apologize, but hey, I'm going to go have some fun in Las Vegas. If anybody's in Las Vegas, let me know. Maybe we'll catch up for a drink. But I'm going to be in Las Vegas Thursday, Friday, Saturday, Sunday, and Monday. I'll be back here to do things on Tuesday for everybody. Now, let me ask some last-minute questions here. Not sure if you've answered this in previous crypto show, but what is the benefit of pooling your money for liquidity? You mean putting money into liquidity pools? Well, if you put your money into liquidity pools, which is kind of an advanced topic, you earn fees by putting your money in there. So let's say it's an Ethereum and DAI liquidity pool, 50-50 pool. So half of the pool is Ethereum, half of it is DAI. you are creating a market. You are providing liquidity to the market. And anytime somebody does a transaction there, you get paid a small fee. However, there's big risks there, and I can't go too deep into it. One's called impermanent loss. That's one of the big risks that you have with these liquidity pools. So you could technically lose a lot of money in a liquidity pool, especially if it's a very thinly traded one. But the main reason is you get rates of return and you make money. And that's it, trying to generate income streams. I had better hair. He just has hair. I think he just has a big hair piece. I think he's got plugs or some kind of weird thing. I'm just losing hair. All right. Thanks, everybody. I got a 3 o'clock call I got to get on to and get prepped for. So, again, thank you guys so much. I hope you enjoyed Bill Addiss. Apologize for taking so much time off, but I just got to do what I got to do. So, if you're in Vegas, email me, TraderMerlin@gmail.com. If not, send in your questions, and I'll have those all ready for our Tuesday show on November 2nd. Hard to believe this month will have come to an end. Happy Halloween, everybody. I'll wear my costume for you guys on the 2nd as well. Have a fantastic remainder of your trading week. Careful with those earnings tomorrow, and I'll see you guys next week. Take care.